Imagine building a multi-billion-dollar superhighway, but forgetting to build the on-ramps. That is exactly what is happening in the current phase of the artificial intelligence infrastructure build-out. The world's largest technology funds are suddenly realizing that the most powerful processors on Earth are starving for data. If you want to track where institutional capital is moving next, you must look beyond the obvious headlines. Mainstream financial media and retail investors are entirely consumed by the race for the fastest logic chip. They are debating architectures, computing power, and whether NVIDIA or advanced micro devices will win the data center war. That narrative assumes the only requirement for artificial intelligence scaling is a better processor. But that misses the fundamental physics of modern computing. You can design the fastest logic chip ever created, but if you cannot feed it data fast enough, that multi-thousand-dollar piece of silicon sits idle. Think of the processor as a massive engine, and the memory architecture as the fuel line. A massive engine with a tiny fuel line will stall. This is the hidden bottleneck. The true choke point in the artificial intelligence supply chain is high bandwidth memory, or HBM, alongside standard DRAM, and the advanced packaging required to physically connect it all. For decades, computer memory sat on a separate section of the motherboard. But complex models process so much data that physical distance creates unacceptable latency. To solve this, the industry shifted to advanced packaging. Fabricators now take multiple layers of memory chips and stack them vertically, like a high-tech skyscraper. Then, they punch microscopic pathways straight through the silicon to link them together, placing the entire memory stack on the exact same base layer as the processor. This is an extreme engineering challenge requiring atomic-level precision, and it is entirely rewriting the capital expenditure cycle. The cash flow is rotating down the supply chain, creating a massive opportunity in the semiconductor equipment layer. Let us break down the market map into investable layers. The first layer is the memory manufacturers. There are only 3 dominant players capable of fabricating the specific memory required for advanced systems. While South Korean heavyweights SK Hynix and Samsung control the lion's share of global production, the primary U.S.-traded titan is Micron Technology, ticker MU. Micron is aggressively transitioning its fabrication lines to prioritize high-bandwidth memory. Because these advanced chips consume up to 3 times the wafer capacity of standard memory, every time a line is converted, it removes overall supply from the broader market. This structural squeeze pushes up legacy memory prices while capturing massive margins on premium chips. The second layer is the equipment toolmakers. You cannot build a 3D memory skyscraper without specialized multi-million-dollar machines. This brings us to the U.S. traded equipment watch list. First, we are watching Applied Materials, ticker AMAT. They are the global leader in materials engineering. Depositing ultra-thin layers of metal and insulation perfectly is non-negotiable for advanced packaging, making their deposition tools mission-critical. Next is Lam Research, ticker LRCX. When fabricators stack memory chips and drill microscopic vertical holes to connect them, they require extreme precision etching. Lam Research dominates this exact deep silicon etch market. As advanced memory volume scales, demand for their highly specific tools rises in tandem. We are also monitoring KLA Corporation, ticker KLAC. In advanced packaging, yield is the most important metric. A single microscopic defect can ruin an entire processor unit. KLA is the undisputed king of metrology and inspection, providing the tools necessary to catch defects at the atomic level before they ruin the batch. For investors who prefer to avoid single-stock risk but want to capture this exact infrastructure rotation, broad exposure can be found through the iShares Semiconductor ETF, ticker SOX, which heavily weights these critical equipment makers. However, any macro thesis carries specific risks. The primary risk here is geopolitical. The U.S. government maintains strict export controls on advanced semiconductor manufacturing equipment, and sudden policy changes can immediately restrict toolmaker revenue streams. Another risk is capital expenditure digestion. Mega-cap technology companies are spending aggressively on infrastructure. If software monetization lags expectations, those companies could abruptly pause their data center build-outs, forcing foundries to cancel equipment orders and triggering a cyclical contraction. So, what are the specific signals to monitor next? First, track the quarterly capital expenditure guidance from major foundries, specifically looking for capacity expansions in advanced packaging. Second, monitor the transition speed at major memory fabrication plants. If standard DRAM lines continue converting to high-bandwidth memory rapidly, the supply squeeze remains intact. Finally, watch the order backlogs for etch and deposition toolmakers. Expanding backlogs confirm that physical manufacturing capacity remains the primary constraint. The crowd will always chase headline consumer software, but institutional wealth is built by supplying the microscopic picks and shovels. For a deeper breakdown of this infrastructure trade, including our full institutional watchlist and research frameworks, click the link in the channel profile to read the brief on our Substack. And if you want to see the capital flow before the public narrative catches up, subscribe to the channel. I will see you on the floor.